From the University of Westminster, this is The Week Ahead with Dave Coker.
All right, guys, welcome to The Week Ahead. This is Sunday, September 20th, and in this series of videos that come out every Sunday night, we try to take a look at significant market-moving events over the next 5 trading days. And this will help you understand not only drivers of change in the markets, but also help you prepare. When things happen, you can actually profit. So what do we got going on? Key events in summary form. First of all, it's still with us. The entire world is really being impacted. Although curious, Africa is not really impacted to any great extent, but the Western democracies as well as Asia, and it's not going away. So we got to watch the news every day on that. U.S.-China tech war. Yeah, this is a very sad outcome for the United States. They have to outlaw technology because they can't compete. And the thing that's laughable about this entire episode, it's tragic, but it is laughable, is that they keep pointing out about they have allegations the Chinese are stealing user data. Well, what's the user on TikTok? What is the average user? The average user is a 12 to 14-year-old girl. Second of all, they don't even talk about the amount of data that Facebook steals, that Twitter steals, that Google steals, that Instagram steals. But I guess that's okay, because they're owned by U.S. entities. It's totally absurd. And this is the kind of thing the U.S. can do once and get away with. Although the Chinese have a long memory, they're very reasonable people. It won't happen a second time. It's just absurd. Corporate bond issuance frenzy. My God, there's a lot of stuff going on here, guys. We're seeing about $42 billion coming to market this week. And about half of this, maybe about 60%, according to the papers I've got, is for the retirement of higher yielding debt. So it's for a good purpose. They're not taking on new debt. What they're doing is they're financing at lower interest rates. So they're raising a bunch of money so they can extinguish some of the higher debt, that higher interest rate debt that they've got out there. Markets are still trying to figure out what's going on with the Fed decision. The Fed has said that they expect interest rates to stay near zero until 2023. It's a long time away, and we're trying to figure out what is going on. And this is driving all sorts of craziness in the markets. And what about this? More quantitative easing? Yep. One of the Fed governors has said it's necessary, and usually they float those trial balloons, and then they actually take a decision. Let's take a look at the S&P 500. Here I've got year-to-date returns. And guys, you can see the way this chart works, we're going to be looking at this every week for different metrics. The way this chart works is red means there's declines, green means there's increases. The deeper the green, the brighter the green, I should say, the darker the red, the higher the increase or the sharper the fall, respectively. So you can see this is very much a tech market. Microsoft, Apple, Amazon, all doing pretty well. Walmart, they're transforming into a tech company to some extent. Got Google, Facebook in there. And then losers down here, the banks. And it's very interesting recovery because in 2009, banks were the big winners when we moved out of that, out of the market crash that was the global financial crisis. We're just not seeing it this time. Price to earnings ratios, we're going to be talking about those a great deal. And essentially what we're doing is we're taking the share price and dividing it by the earnings, and we get a number that reflects how fairly valued these assets are. So you can see Amazon's running a PE of 113.58, Microsoft 34, deep red. These are incredibly expensive stocks at this point. The average long-run PE for the entire stock market in the States is roughly 17. This is absurd, some of these valuations that we're seeing. We'll pay attention to them. We'll talk about them a little bit more over the next few weeks. And this whole market reminds me, we see all the money in tech, and yeah, this is, I like putting together little graphics, and this is an interesting one. Basically, these are Instagrammers or influencers or whatever they call themselves. And of course, they always go and try and take a picture in some extreme location. And the young lady's hanging, and the guy's got her, holding on to her, and he's sitting up there. And boy, they're both a little in a strange position. But regardless, her position is a little bit more precarious than the guys, and that corresponds with what we're seeing with the tech stocks versus growth investors. Now, oh my God, my animation, holy cow, sorry about that. I'll just bring the whole page down. All right, my apologies for that. All right, Monday, September 21st. Now, we've got a lot of Fed speak going on in the market this week, and that's significant because the Fed, you're going to see there's a lot of governors, a lot of people associated with the Fed coming out and speaking, trying to communicate Fed policy through as many different mechanisms and as often as possible. So Jerome Powell speaking at 10 a.m., FOMC, Fed Open Markets Committee. You can see here that this is Brainerd and Williams are both speaking up at 12 and 6 o'clock. And then at 11:30 a.m., we've got 3 and 6 month T-bill auctions. And just to give you an idea about how low interest rates are, you can see previous for 3 months was 11 basis points. 6 months was 12 basis points. We don't have a forecast, but these are incredibly low interest rates. It's really amazing, record low. And this chart, guys, pulled it off the wonderful stockcharts.com. You can use them for free. You don't have to give them any money. Although if you give them money, you can save your charts and do other customizations not possible. But regardless, check out this. Look down here in March. You can see what happened to yields in March. In particular, the 3 month dropped all the way down to 0. It's absolutely incredible what's happened. Interest rates are at record lows now, and interest rates have been even lower. We're sort of bouncing up a little bit, but not that much. On Tuesday, September 26th, we have the Red Book coming out. Now, the Red Book measures retail sales in the United States. They capture about 9,000 chains. And basically what the Red Book does is helps us get an idea about consumption, which is very important because keep in mind, in America, it's the same thing in the UK, not to the same extent, but in America, 70% of GDP is driven by consumption. In the UK, it's a little bit north of 60. I don't know the exact number off my head. But the point is this, guys, we see consumption, retail sales, expected to fall, right? We're, again, prior was 1.6, month on month, year on year was 1.2. We don't have a forecast, but watch it. At 10 a.m., we got existing home sales month on month. Look at the blistering pace that we had. If you go back 1 month, 24.7% increase. Now we're starting to slow down a little bit, a 2.4% increase. Oh, and he's back. Chairman Powell speaking again. Pay attention to him, guys. You don't want to be reading this stuff. You want to watch him speak. And you'll get a lot of insight about what's going on. At 1 o'clock, we got 2-year note auctions. Prior was 0.155% or a little bit north of 15 basis points. Again, really low. That's your reward if you lend money to the United States government for 2 years. If you purchase a treasury note on auction, at the prior auction, your reward for giving the United States government money for 2 years was 0.155%. It's crazy what's going on right now. Wednesday, September 23rd. At 0700, we got the Mortgage Bankers Association 30-year mortgage rates. Here's an interesting thing. You can see the prior was 307. We don't have a forecast. Now, guys, the point is this. You know, America does a lot of things wrong, an incredibly large number of things wrong, but we do money right. And when you buy a property in the States, if you take out a mortgage, a 30-year mortgage, you know exactly what that mortgage payment's going to be from now, 2020, all the way up to 2050. They lock it in for 30 years. I don't have any debt. I don't like debt. I did have a mortgage going back about 10 years ago. I hated every minute of it. I got rid of it real quick. I paid it down. But I couldn't get a commitment, or I couldn't lock a rate in for more than 7 years. And it got more expensive. I was fortunate because I was in an era of declining interest rates in the UK. So I locked it in for 2 years and just kept refinancing it down until I killed it. FOMC member Williams speaking at 0900. My gosh, I'm so sorry about this. I just realized I typed FMOC, not FOMC. So it's Fed Open Markets Committee. And basically, they're the rate setting body. And you have to watch these guys. So Williams is speaking, 9 a.m. 9 a.m., we got house price index, month on month and year on year. House prices, month on month, forecast to go up about 0.9%. Year on year, 5.7% increase. That's a healthy increase. There's a lot of demand for houses in the right places in the States. Same thing in the UK, guys, although keep in mind with the state of the economy and possible lockdowns, I think houses are going to get relatively cheap. We've got a huge unemployment problem in the States right now, so we're going to see prices drop. At 1300, we have 5-year note auction. Prior was 0.298%. Not sure. We don't have a forecast. What am I paying admin for? I'm not getting forecasts. Not sure what's going on there. But we don't have a forecast for that. But you can see the prior rate, less than 0.3%, 0.298. And again, that's if you lend money to the United States government, you buy a note at auction, you're effectively lending money to the Treasury for 5 years your reward is going to be less than 0.3%, 0.298. It's absurd. Oh, and again, my animation's all messed up. Sorry about this. All right, Thursday, September 24th at 08:30, we got continuing jobless claims. Prior was 1.26 million, forecast 1.3 million. We're seeing a slight uptick. We take a look at the 4-week average. We like to get an idea of that. It smooths it out. And we can see it's coming in pretty steady at about 912,000 new claims per week. And this is going back over the past 4 weeks. So it's not good, guys. These are people that are unemployed. 912,000 in 1 week filed for unemployment the prior week. We don't have a forecast. At 08:30, we got 4-week and 8-week T-bill auctions. So once again, we've got very, very low interest rates, and I got the nice chart down there. You can see, we see the same phenomena. What happened down there in March? Prior was 0.08 for 4-week T-bills. That's a 1-month T-bill. And yes, that's 0.08 of 1% is your return. The 8-week, a little bit higher, 0.895 for 2-month money. At Friday, September 25th, oh gosh, there we go. Friday, September 25th, we only have 2 things going on Friday, sort of a slow day. So at 08:30, we have core durable goods orders. Guys, these are things like machinery, things like white goods, as the British call it, refrigerators, things that you need for your house. They're durable. And we take a look at this, very, very important. Prior, this is month on month. For August, prior was 1.5. We're forecast to come in at 11.4. Slight, no more than a slight uptick, a big boom up in durable goods orders. And I don't quite understand what the explanation for that forecast is. I did try to find other ones, and they're all in the same range. So it's really interesting. And again, guys, as durable goods orders goes up, consumption is increasing, and the economy should recover. Although we've got real problems in the States with COVID, with coronavirus. And at 08:30, we got durables excluding defense. Once again, month on month for August. All we're doing here is we're taking durable goods and we're stripping out defense. And we can see that it's a 10.1% increase prior. Forecast, we don't really have anything there. All right, guys, this has been the week ahead for the week beginning September 21st. It's dated September 20th. We do this every week. And the intention is to give you an overview, give you insight into what's going to happen in the markets over the next week. Thanks for your time, guys. Take care.